So today, we are going to dive a little bit deeper into policy loans. In our last video, we looked at a mass mutual policy on a 40-year-old individual. It was a 10-pay policy. We actually used that model for the past several videos. But in our last video, we looked at a fixed loan interest rate of 6% and focused on a direct recognition policy. You may recall with the mass mutual direct recognition contract, if we borrow and then repay, we actually have more money in cash value compared to the scenario where I just park money and let it sit and grow. So in this video, we're going to look at a direct recognition policy, but it won't be with Mass Mutual. We're going to look at the new Guardian product. When I say new, since the 7702 update, where they have reduced their fixed loan interest rate to 5%. So we'll have some fun with this one. We're not going to look at the same 40-year-old individual with $100K per year going in for 10 years. We're going to mix things up a bit in the next several videos, actually. What will remain consistent is not that loan amount, but this. We're going to see what it looks like if I take policy loans and pay them back in full. If I take policy loans and only pay the interest. If I take policy loan and don't pay anything back at all. If you're considering a cash value life insurance policy, or if you already have one and you're looking to utilize that policy for loans, what is always beneficial to look at is what is the impact of policy loans. Maybe I plan on paying it back, but if life happens and I can't pay anything back, what is the actual impact of my cash value? So we always like to look at this. It's extremely valuable. With Guardian, we've got a direct recognition policy. Guardian has a current dividend interest rate of 5.65%, and all new policies start out with a fixed loan interest rate of 5%. So before we jump into the numbers, let's look at a little bit of more information here specific to Guardian. Well, in this case study, what we're going to look at, 35-year-old individual, the funding will be $100K per year, but for 5 years in this example, not 10 years, we're going to look at a policy loan of $300,000 in year 6. Now, how Guardian's loans work, their loan interest works, I should say, is we start out with a fixed loan interest rate of 5%. If you start a new Guardian policy, that's going to be the loan interest rate, and it will be fixed every single time at 5% unless they update their contracts again. Now, what they offer is at the 10th year, you can change that fixed rate to a variable loan rate, which has a current rate and a floor of 4%. If you elect to bypass the variable rate, you said, I don't want to go variable, I want to keep a fixed rate of 5%, what will happen is at the 20th year or age 65, whichever comes last, that fixed rate will actually drop from 5% down to 3%, with the exception of their 10-pay product, which we'll look at in a later video. That works a little bit differently. Now, these rates we have to the right are discounted rates and what we are actually billed anytime we take a policy loan. So how it works is, let's assume for a moment that you take a policy loan of $10,000 and you take it on your policy anniversary date, so there's a full 365 days of interest accrual. If you have a 5% interest rate, what will that come out to? Pretty simple math, $500. Now, what will actually happen if you have a Guardian policy is they will bill in advance, but at a 4.76% rate. So what that means, when you actually take that $10,000 loan, $10,000 will be sent to you. That'll be a check or direct deposit into your checking or savings account, but your loan balance on your Guardian online portal will actually be $10,476. Now, what's interesting about this is if you were to pay it off the next day, you would pay just a little bit more than $10,000, 1 day of accrued interest. What happens with Guardian policies, and a couple companies function like this, is they bill that 4.76% rate, but they bill that loan interest up front. If you do not pay the loan interest on the anniversary date, what happens is it actually turns into 5%. So as an example, 10,476, and you'll see this in the examples we go through. If you say, okay, I have the loan outstanding for a full year, I'm not going to pay the loan interest this year. What'll happen is your loan balance would actually turn into $10,500. If you do pay the loan interest, it'll be a $476 payment and your loan balance will remain at $10,000. Fun stuff, right? Very easy to follow. Loan interest can be confusing. Now, what I'll add as an additional side note is if you said, hey, 6 months in, I'm going to pay my loan off in full, what'll happen? Well, you would see on your portal $10,476. If you sent that dollar amount in, remember, you're only billed for 6 months of interest. Even though it reflects the full 12 months, 6 months in, it would be half of the 476, so it'd be what, 10,235, call it, a little bit more than that. So approximately $235 of interest would go to Guardian. The rest would be refunded to your policy cash value. So loan interest does accrue at annual simple interest. It accrues daily. My point is, if you pay it back prior to the anniversary date, it still accrues as if it were accruing and was not billed up front. Our first video, which went through loan interest accrual, and we've got other videos on that, provides more details on that, but I just want to clarify this point because Guardian does things a little bit differently here. So let's look at some scenarios, shall we? And we'll actually go through this and it'll provide a little bit more clarity when we see some numbers too. Before we just jump into the Excel comparison sheet, this is nice because it provides a direct comparison. Let's take a look at our illustrations here. Here we go. So I went with a clean 1090 split. We've got a 35-year-old individual here. When I say a clean 1090 split, the underlying base premium, 10% of the total desired payment. $10,000. Actually, there's the whole life death benefit. It purchases us $600,000 and change. Then here is our PUA rider, $90,000, which does satisfy the term cost as well. So if we have a scheduled PUA rider attached, that scheduled PUA payment will satisfy the 1-year term rider as well, which is good to be aware of. So as we take a look at this, here we go. This example is pretty straightforward. If I just pay money into it, let it sit and grow. This is always beneficial to look at to really set the foundation when we start to look at loan scenarios. So if you're interested in using policy loans, say for real estate, if I'm you, what I would ask for to see is, what does my policy look like if I just let it sit and grow? And then what does it look like when I borrow? If I pay it back, what happens if I can't repay it? Ask to see numbers here instead of just hearing about how it works, because where people get upset is when they see something that contradicts what they were told. It's good to have full transparency here. So here's our payments, 5 years, nothing thereafter. Here's your cash value. Total dividend interest rate is 5.65%. If you've watched any of our prior videos, we know that's not what our cash value is growing by. We can see that if we just do a simple IRR formula. We want to look at the net internal rate of return. But let's take a look here. So we're going to look at loan scenarios. Here we go on the illustration before we just jump to the Excel spreadsheets. Stereo instructions. Look at all of this. So we're not going to walk through every column in this video. We're just going to go to the columns to look for. In this particular example, there's a $300,000 loan. There's your cash value. So the available cash value is impacted when you take a policy loan. How much did you take a loan for? 300 grand. How much did your death benefit drop by? 300 grand. With the term rider we used, we have a level death benefit, which makes the loans much easier to follow because we see that clean dollar for dollar reduction in this example. Now, we take the $300,000 loan. Here's our loan balance. This example represents what the policy looks like if you borrow and pay the interest only each year. Here's where it gets interesting. Fixed loan interest rate is 5%. Here's the loan interest amount. And then net after-tax outlay represents the interest payment you're making each year. So we see it match up. Interest comes due, you pay it. What's it come out to? $14,286. What was that discounted rate? About 4.76%. So when we assume that the interest is being paid each year, we're going to see the discounted rate. We'll see it turn into a full 5% in the example where we do not pay it. So we'll get to that shortly. So let's take a look at some of the side-by-side comparisons, and we will have some fun with this. So what we've got here, on the left, what the policy looks like if I park money and just let it sit and grow. This is the first illustration we looked at. This is actually an L95 policy, dividend interest rate of 5.65, loan rate of 5%. $100,000 goes in. Here's your cash value, $83,000 and change. This is designed with a $10,000 premium, term rider for a little over $400, the rest toward PUAs. If you have a Guardian policy that was started before 2022, or if you've seen any of our older content, it's very common for that to be around $87,000, 87% of the total first year payment with a 10/90 split. Why we see a difference is because as a result of the 7702 change, Guardian actually increased their PUA rider fee from 5% to 10%. So we see that same out of pocket, same design, exact same design as what we used to do from a model standpoint here, and 83 instead of 87. Higher PUA fees is why I have less money up front. Now, year two, I pay in $100,000. What happens? Grows from 83 to just about 182. So you almost get the full 100K payment back. Not quite all of it because I've got the PUA fee, but why I get the majority back is the base premium. This is a L95 product. The base premium begins coming back to cash value beginning the second year with this product. And then year three, paying 100, grows from 181 to 283. So I get the 100K back, 100K I pay in back, plus just about another $2,000 on top of it, closer to $1,500 in this example. Each year goes by, what's in yellow represents my break-even point. Okay, we can take loans anytime we'd like. In this example, just for simplicity, we take a policy loan beginning year 6, after the 5 years of funding. Again, we can do it anytime we'd like. So what is the impact of that policy loan? If this is you using this for real estate investments or business or whatever it might be, if you want to buy a nice Ferrari, here's your cash value. Let's compare it to the example where I don't touch it. I see just about a $300 reduction there. What do you notice about the death benefit? $2.3 million, $2 million. Dollar for dollar reduction in this example. Now, to transition back to the growth example, you will notice this question comes up sometimes. Why does the death benefit drop here? What we did was remove the term insurance rider we attached, which is a cost-effective way to raise the MEC limit. We also did what's called a reduced paid-up option, which eliminates the premium altogether. Basically, we reduce the death benefit as much as we can to improve cash value growth. That's why we see the death benefit drop there. And year 8 has to do with the MEC test, which has to do with the first 7 years. Fun stuff. Now, back to this guy. So we see the dollar for dollar reduction on the death benefit. Anytime I take a policy loan, I will see that occur. This is a big reason why I continue to receive dividends, in this case, the 5.65% dividend interest rate on any remaining equity, and then I still receive a dividend, but it's at 5% on the loan dollars. So Guardian's practice is, and has been for a long time, to match the dividend rate to the loan rate. So older contracts that have that 8% loan rate, I actually have one of these. It's about the first policy I took out, it's a very small one. But if I take a loan against it, the loan interest rate is 8%. What happens is those borrowed dollars receive a dividend rate of 8%. Same thing is true if you have an old Guardian contract with a 6% loan interest rate. If I decide to take a loan against it, a dividend of 6% is credited to the borrowed funds. Interesting stuff, right? So here is my loan interest. That comes out to about 4.76%. We're paying the loan interest each year on the anniversary date. Remember that discount where the loan interest rate is 5% unless we pay it? So here, 4,286. We pay it each year. Purple represents loan payments. The next year, we apply $30K toward the principal balance and make a loan interest payment. So your true net out of pocket in year 7 in this example, there's no premium or PUA payments, but we've paid a total of $42,857 toward the loan interest and principal. Now, as we pay it down, what do we notice here? We pay it back. Let's do this. by age 50 in this particular example. In the example where I just let it sit and grow, what do you notice here? 830 and change, just about 832. In the example where I borrowed and repaid, what do you notice? 806 and change. Death benefit is about 50 grand less as well. Why is that? The reason why, lower dividend rate applied to the borrowed dollars. Older guardian contracts, it's the opposite. So this is something we like to track and be aware of each year. Some people look at that and say, hey, that's fine. It works out in the wash over time. Some say I'm not comfortable with that. So we look at a different company or perhaps a cash value collateral loan. At that point, it doesn't matter if I have non-direct or direct recognition, in my opinion. But let's look at some other scenarios. So we see what it looks like if I borrow and repay. Let's transition on to the no repayment scenario. By the way, if dividend rates went down below 5%, then I would see things flip a bit. Meaning, if I borrow and repay, I would see more money in cash value compared to what it would look like if I just let it sit and grow. That's if dividends went down and fell below 5%, particularly with Guardian. Kind of like the old contract works. So, loan and no repayment here. We take a $300,000 loan. It reached $315,000 that year. Sometimes we just plug in $300,000 because if you request a $300,000 loan, you're going to get $300,000. But our loan balance is $315,000. Policy internally actually books a $315,000 loan because that loan interest comes due for 15 grand and we don't pay it. If we do not pay the loan interest, the policy borrows against itself to cover it. So the true loan the policy has taken would have been $315,000, the $300,000 we took out and received, and the $15,000 in interest that we did not pay. Now, what do we notice here? Well, first, what's 5% of 300 grand? There we go. So with Guardian, if you're not paying the loan interest, then we see it net out to the true 5%. As time passes here, what do we notice? Let's go down to age 85, and I want to point something out here. So we did this somewhat deliberately. What do you notice about the cash value in the far right? It was climbing up. But what do you notice right here at 85? Starts to go down. Now, how much you borrow and what the dividends and loan interest rate looks like in the company will impact this. But one of the things that we mentioned earlier is that it's beneficial to see what a policy looks like if I take a loan and don't pay it back at all. If we would have looked at, or if we were to increase that loan to $400,000, you would see a different story here where it would actually call for money. Meaning I would have to pay it or the policy can potentially lapse. And that can spark a whole lot of other issues too. So from an awareness standpoint, this is a big reason why it's beneficial to see these types of models up front. And because this is a fixed loan interest rate, does provide a little bit more certainty. The dividend rate is variable, obviously, which will impact things, but it is good to see this kind of stuff up front. Let's look at interest only. We can wrap up with this. Here we go. Same thing, annual loan, $300,000. We pay the loan interest, which is why we do not see the balance increase. And this example assumes we're just going to pay the loan interest forever. There we go. Let's go down to age 85. Beautiful. What do we got? If I just let it sit and grow, just about 4 million. In this example, about 3.2. Now, one thing I forgot to mention. Remember what happens with Guardian if you keep the fixed loan interest rate, which in this example we're assuming we do, at year 20 or age 65, whichever comes last, what happens to the loan interest rate? 5% drops down to 3%. If I'm paying that, it actually comes out to a discounted rate, a little over 2%. Point being, if you're looking at this, you notice right here, at age 65, the loan interest is not 14,286, it's 10,145. I'm paying less loan interest because the loan interest rate has gone down. Also, what happens, the dividend rate matches the loan interest rate at that point in time as well. So if I have a $300,000 loan outstanding, I'm still receiving a dividend rate on that, but it's a 3% dividend. Again, this is looking a ways down the road, but it's good to be aware of that stuff. So I hope you enjoyed this one. I did. In the next video, we are going to look at changing to the variable loan interest rate so we can see what that looks like. We're going to start the loans in year 11. And that one will be fun. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.